Most investors can and should want to make money, but what differentiates the Moneyball method is we define explicitly what the goals are that we're trying to fund, when the money is needed, why those are important, how they make you feel, how they are integrated with all of the other values, goals, and aspirations that you are trying to achieve, as well as your age and life expectancy, family obligations, health and fitness, and exposure to market risk. That is the principle. We want to be able to answer the question to make money for what? That is financial independence. That is emotional intelligence. That is money consistently being not stupid. Hello, everyone, and welcome back to the Moneyball Method podcast. My name is Mark Shupe, the author of the Moneyball Method, a middle-class manifesto for objective investing. And as I record this, it is January 1st, 2026. With that, I would like to wish all of you a Happy New Year and thank you for your interest and participation in the Moneyball Method Substack system, as well as viewing these podcasts. And what I'd like to do is take a quick look back at 2025 and use that as a springboard for the new year. In June of 2025, I was able to publish my book on Amazon and at the same time create a Substack account where I publish articles about economics, finance, politics, ethics, history, all in support of the Moneyball method. And I, again, want to thank you for reading those brief essays and also ask a favor. If you find value in them, please share them. Share them with people who have questions about rights, liberty, and justice. Share them with people who are concerned about their own ethical as well as political independence. That is what the Moneyball method is all about. And then in September of 2025, I began podcasting at the urging of my talented and gracious producer, who has drawn out of me some insights and new skills that I'm continuing to develop. And along those lines, I also joined a Toastmasters group to try to help improve my communication and speaking skills. Needless to say, 2025 was a banner year for the Moneyball method. It didn't exist in 2024, but it will continue in 2026 with greater resources, in particular the launch of a new website that I hope to use to coalesce all of the content that we're creating here and reach a much larger audience. One of the things that was accomplished in 2025 was a book review by a nationally well-known financial journalist who is the financial editor at realclearmarkets.com and a contributor to Forbes magazine. He published a lengthy and very positive review in July of last year, and I'd like to begin my comments today with a quote from that book review. John Tamny wrote, "Were he still with us, Charlie Munger might admit that when it comes to money, it takes a lot of intelligence, or at least emotional intelligence, to be consistently not stupid." That is an interesting quote. Charlie Munger, if you've not heard of him, is a very famous investor and partner of Warren Buffett. But what did Charlie Munger mean by emotional intelligence? Well, like my financial independence podcast, I want to break that down into the two concepts, emotional and intelligence. What is intelligence? It can mean different things. It could be your biological capacity for integrating perceptions and first order concepts into more abstract ideas and learn and understand complex systems. Intelligence could also be situational intelligence, being aware of your surroundings and the nature of the forces at work, whether they be natural or man-made. Or intelligence could be your general body of knowledge that you've accumulated over a lifetime of reading, studying, watching, and that all depends on your desire or your decisions regarding to think or not to think. What about emotions? What are they? They are subconscious reactions. They are automated responses to events, to people, to feelings, to ideas, to experiences. In fact, your subconscious mind is probably the most powerful computer the world has ever known, and it is always operating. However, your subconscious mind, your emotional responses can be programmed. They are under your direct control based on the ideas that you subscribe to, the experiences that you have, and they can either be positive or negative. Positive responses would be things like happiness, satisfaction, pride. Negative responses, it could be anger, frustration. And those are not necessarily unhealthy. It depends on the stimulus. It depends on the experience. It depends on what you are responding to. So with regard to emotional intelligence, what does that have to do with financial markets? Well, I'll describe that in a little more detail as we talk about 2025. In the context of being consistently not stupid. In 2025, we had very positive returns in capital markets all over the world. We also had positive returns in commodities. I'm going to start with gold. 2024, December 31st, I should say, gold closed at $2,625 per ounce. On December 29th of this year, 3 days ago, it closed at $4,397 per ounce. That is a gain in dollar terms of 67%. But what did dollar do? To be consistently not stupid, let's understand that gold doesn't do anything. Gold just sits there. It does not have an internal rate of return. In fact, because of gold's stability, because of the fact that it is indestructible and nearly every ounce of gold that has ever been mined is still in existence, it is the ideal form of money. So it's not so much that gold appreciated, it didn't. It's the fact that the dollar depreciated. The dollar lost 67% of its value relative to gold in 2025. Gold did not rope-a-dope many other currencies. The Japanese yen and the European Union's euro fared much better. But the dollar lost ground, particularly in the first half of the year, against most major currencies around the world. But let's talk about capital markets. Let's talk about intangible assets such as stocks and bonds. With regard to the U.S. stock market, how did it perform in 2025? Using the Russell 3000 index as a proxy, and I use that consistently because it is the broad U.S. market if we want to track how U.S. equities are performing. The Russell 3000 began the year on December 31st at the index level of 3357. It closed the year on December 29th, 3 days ago, at 3919. That is a gain of 17%. U.S. stocks on average rose 17% during the course of the year. And of course, in the news, a large chunk of that was the Magnificent Seven, the seven largest capitalization stocks in the US, including Amazon, Nvidia, Alphabet, Microsoft. Tesla was replaced by Broadcom, a couple of others. Those comprise more than 1/3 of the market capitalization of the S&P 500 and a little more than 25% of the Russell 3000 index. However, one thing we noticed in 2025 was that breadth improved, meaning the number of companies that outperformed the index rose in 2025 to about 37% of all companies. And that is an increase of 23% of all companies in the year 2023. Why don't I talk about the S&P 500? Well, it's a little more concentrated index. It's only 500 stocks, and it did roughly the same as the Russell 3000 anyway. But I believe the Russell 3000 to be the best benchmark for making asset allocation decisions for our clients using the Moneyball method. What about international stocks? The International Developed Index is known as the MSCI EFA, or Morgan Stanley's Europe, Australia, and the Far East Index. It began the year on December 31st, 2024, 2262 level, and it closed the year on the index at the level of 2895. That is a gain of 28%, substantially outperforming U.S. stocks, which is quite unusual, and outperforming them by double digits, 11%, which is even more unusual. But I think we can attribute a big part of that outperformance relative to U.S. stocks to the fact that the U.S. dollar was weak compared to most global currencies, and the MSCI index is translated into US dollars. But where I really want to talk about is not equities, even though that is the profit center for Moneyball investors and for all investors around the world, besides venture capital and private equity. And that is the performance of the US Treasury bond market, and in particular, the 10-year Treasury index. How did the 10-year Treasury bond perform in 2025? Well, to begin the year, the yield on the 10-year U.S. Treasury bond was 4.58%. Typically, bonds are priced in terms of their yield, not the dollar price or the currency price. The 10-year U.S. Treasury closed the year 3 days ago, I should say, at 4.14%. The yield dropped from 4.58 to 4.14, which is actually an increase in the price. Remember, there's an inverse relationship in bonds between the yield and the price. Bonds rallied. They gained 10% in value. The total return on the 10-year Treasury was more than double the yield. That's interesting. How did that happen? More significantly, how did that happen when the U.S. Treasury debt load began the year at 35 trillion with a T, which is 120% of gross domestic product, by the way. The U.S. is a debtor nation, and it grew another $3 trillion during 2025. So you've got this massive debt load that is increasing at what seems like an increasing rate. Yet the yield went down. But what does it mean when the yield goes down? It means demand went up, or prices went up because demand went up. The demand for the bonds was increasing faster than the debt load, or the supply, I should say, of bonds issued by the U.S. Treasury Department. How does that happen? What is wrong with this picture? Particularly now that the U.S. debt load exceeds gross domestic product. Maybe there's a problem with gross domestic product as an indicator of the health of the U.S. economy. And this is where I get to money, to be consistently not stupid with money. GDP is a stupid indicator. In fact, I believe the third quarter of 2025, the most recent data came out saying that GDP in the United States grew at 4.3%, well above average, very positive results, and a totally useless number. Because that growth occurred at a time when imports fell, which reduced the GDP number to 4.3%, meaning the US economy was a lot healthier than the GDP number indicates. If the GDP number is not a reliable indicator of the health of the US economy, then why use it? Because it supports government spending as a way to goose economic performance for the benefit of politicians and bureaucrats who rely on taxes and fines and additional debt to line their own pockets. But so far, what I've been talking about are time-weighted returns, percents per year. That is not the Moneyball method. The Moneyball method uses dollar-weighted returns and focuses on the performance of your particular cash flow strategy and investment strategy. We focus on the things that you know about and can control. We cannot predict the future of capital market performance, nor will I attempt to do so in this podcast or at any other time. So what I'd like to do right now is shift the conversation to dollar-weighted returns and read you one more quote from the Forbes and Real Clear Markets review of my book titled The Moneyball Method. This is John Tamny writing last July. It was while at these institutions that Shupe happened on the myriad fallacies associated with best practices on the matter of wealth management. Sensing customers were being misled by accepted wisdom, he turned his own principles into practice. What is the first principle of the Moneyball Method? Well, the first one I'm going to talk about today is the one that answers the question, to make money for what? Most investors can and should want to make money. But what differentiates the Moneyball Method is we define explicitly what the goals are that we're trying to fund, when the money is needed, why those are important, how they make you feel, how they are integrated with all of the other values, goals, and aspirations that you are trying to achieve, as well as your age and life expectancy, family obligations, health and fitness, and exposure to market risk. That is the principle. We want to be able to answer the question, to make money for what? That is financial independence. That is emotional intelligence. That is money consistently being not stupid. But how do we put that principle into practice? What is the practice that we employ on a regular basis to evaluate our cash flow strategy? I call it funding status. We want to calculate, respecting the fact that future capital market performance is uncertain, what investment strategy will give you the highest likelihood of success with the least amount of risk. In other words, using baseball terms, the lowest cost per win. What is your risk capacity? What is your spending capacity? We know that in dollar terms because we focus on dollar-weighted returns, and we change the performance benchmark to one that looks backward against arbitrary historical indexes, but looks forward in terms of dollars of future wealth. So to wrap up my comments for the new year, I would ask each of you, challenge each of you, and commit to declaring your own financial independence. In other words, independence from the wannabe government handlers over the economy, over the markets, and over your investment strategy. Have defined goals and aspirations. Be able to answer the question, to make money for what? And using the health and fitness metaphor, turn on the heart rate monitor. What is the level of risk exposure that will give you the maximum likelihood of meeting or exceeding your spending goals and avoiding unnecessary risk? In other words, your aerobic capacity. And with that, I'd like to wish each of you a happy new year. Please share this podcast with your friends on social media, and I look forward to seeing you next week. Thank you.